Okay. Good morning, everybody. Welcome to our webinar about the second PPP program, or the second round of Triple P. I'm going to let everybody sort of roll in here for a moment while we start what feels like a Monday, even though it's a Tuesday. Let me see here. So just give everybody a second. I hope everyone's having a good day and ready to learn all about this very exciting Triple P stuff. And I know it was really great last time, as our guest speaker, Josh Steele, did an incredible job of breaking down what it is we're doing, but I'm sure it'll be just as informative this time. So now that we've got a number of people logged in, I'll go ahead and get started to make sure we're respectful of everyone's time. But welcome once again to the Orange County IDA's webinar focused on the second round of Payroll Protection Program. I'm Laurie Villasuso, the Orange County IDA's CEO. The Orange County IDA organized a number of webinars in 2020 to help Orange County businesses cope with COVID-19. We covered a variety of business topics on these webinars, from the first payroll protection program and economic injury disaster loans to opening procedures as our economy started up again after the New York on Pause program, and even information on re-envisioning your business in this new normal. Today, we're fortunate to have one of our most well-respected and thorough presenters return to this virtual stage to provide details on the new round of the Payroll Protection Program. The funds available in this second round can be used for different types of expenses. There are eligibility requirements for businesses that have applied in the first round of the Triple P, and even loan forgiveness procedures have changed for some businesses. So I feel really fortunate that Josh Steele, a partner at the law firm of Harris Beach, has joined us today to explain this to all of us and help us break it down. At Harris Beach, Josh regularly represents employers in administrative proceedings before the New York State Division of Human Rights, the Equal Opportunity Commission, and Unemployment Insurance Appeal Board. Most relevant to today's discussion, Josh has become one of Harris Beach's experts on the Payroll Protection Program, and we're so pleased he could join us today to share all of the information he knows. So before I turn it over to Josh, I'd like to remind everyone that you can ask questions through the Q&A dialog box on your screen. We'll get to as many as we can today, and those we can't we'll follow up with after the webinar, just like we've done in the past. As a reminder, we will hold most of the questions until the end, unless there's something super important that comes up in the middle. We will hold all of them, so we'll go through them kind of at the conclusion of this presentation. So with that all being said, Josh, I will turn it over. The stage is yours.
Thank you very much, and good morning, everyone. Before we get started, I want to throw a caveat out here just so everyone understands what we're dealing with, and we're rather new in the game. We do have some very good guidance on how the Economic Aid Act impacts both first draw and second draw Triple P loans. But we have two sets of interim final rules, and there are many other interim final rules pending. This morning, they just published kind of a bit of a Q&A specific to second draw loans. They always do this to me. They couldn't have published it yesterday morning or Friday afternoon, so that's not addressed in here. But I guess I would make the point that we are getting new information fairly regularly. So there are some questions that haven't been answered yet, and there are some questions that we might have a decent idea about what they mean, but as they actually go through it and receive feedback and comments, SBA and Treasury might make some changes or provide additional guidance. So that's just kind of the caveat here. We're still rather early in the game, especially if you think back to when the Triple P first came out as part of the CARES Act, how long it took back then to feel comfortable about it, and we were talking about a month, 2 months, we're still getting really good guidance all the way until December of this year, answering questions that we still had. So I just want to throw that caveat out there. We're waiting for more information, and this is based on what we know right now. So agenda here, fairly simple. We're going to talk about the impact that the Economic Aid Act, or the EAA, has on both first and second draw loans and forgiveness. This act changed some underlying rules that apply to Triple P loans, both the first draw and the second draw. This is especially important for first draw loan recipients, first draw borrowers that have not yet received forgiveness from the SBA because some of these rules actually apply, some of these changes apply to your situation as well. Then we're going to go through the eligibility and loan size of second draw loans, and then just some tips on the application for the process for the second draw loans. So we could jump right into the next slide. So one of the things that the EAA did was expand eligibility. All right, so under the PPP loans, certain entities weren't eligible, and the EAA expanded it. So now you can be a housing cooperative with less than 300 employees, eligible. 501c6 organizations with less than 300 employees, now eligible. Destination marketing organizations with the same employee count, and nonprofit news organizations with less than 500 employees are also now eligible under the PPP. There is some caveats to that. And in terms of the 501c6 and not-for-profits and destination marketing, you can't be engaged in too much lobbying. If you receive more than 15% of your receipts from lobbying, if it's more than 15% of their total activities, or if the cost of your lobbying exceeds $1 million, you're out. So again, they're trying to keep other people out. One important point, all the previous SBA affiliation rules apply when determining employer size. This applies to second draw loans as well. Now, the issue with this expanded eligibility is a lot of these entities did not receive first draw loans. They thought they weren't eligible. If you are an entity that did not receive a first draw loan, either because you weren't eligible, but you are now, or because you were eligible, but you were concerned or you weren't sure if you needed it, you can still apply for a first draw PPP loan. You've got that ability to do that. That's one of the things that the CARES Act allowed, the Economic Aid Act allowed. Now the loans can be made through March 31st, 2021. So if you haven't gotten a first draw loan, you could do it, and these eligibility rules apply to you now. We can move forward to the next slide. So I think probably the biggest change in the EAA was the expanded eligible uses of the loans, right? So previously, and I guess I'll make another point. If you didn't attend either one of the previous PPP presentations that was put on, I would strongly suggest getting those slides, looking at those slides, reviewing those slides, because this is not a start from scratch. This kind of assumes we have a little bit of background information about the PPP, just because we had to keep it in a short period of time. So if you haven't looked at the previous presentations that you received on PPP, I would ask for those and look through them. So previously, prior to the EAA, PPP loans could be used for payroll costs, which is a big bundle, costs related to the continuation of employee benefits, mortgage interest payments, rent payments, utility payments, interest payments on any other debt that was incurred prior to 2/15, and then refinancing the EIDL loans that were issued between 1/31 and 4/3. Those are all still allowed still, and the EAA added 4 new allowable uses. The terms they use are covered operational expenses, covered property damage costs, covered supplier costs, and covered worker protection costs. And we'll go through each one of those based on the definition that we have in the IFRs. This is a big deal because entities that were having a hard time spending all of the PPP money within a certain number of a week period, we'll talk about that issue as well. We now have more allowable expenses, even if you're operating at a lower level than you were before. If your PPP loan was based on payroll during 2019, then for most of us, the 2019 payroll was significantly higher than the 2020 payroll. So you can run into issues trying to spend that money. Now they're allowing these additional expenses. And again, this applies to both first draw PPP loans, and specifically ones that haven't yet been forgiven, where SBA hasn't issued forgiveness determinations to the lender, and to second draw PPP loans. So we can go to the next slide and we'll talk about these new rules. So what I've provided here for almost all of them is the total extent to the guidance and definition that we've received to date on the interim final rules for these. My guess would be is that there will be some pretty detailed Q&As coming out, specifically providing more guidance on what falls underneath these different categories of new allowable expenses. If you recall back in the spring, that was one of the areas that the Q&As did address quite a bit, was providing us more information on what certain terms like payroll costs, for example, included and what they didn't include. So I would expect that we're going to get more guidance on these, but this is what we have to date. So covered operational expenses are payments for any kind of business software or cloud computing service that facilitates business operations, product or service delivery, processing, tracking, and paying payroll, HR, sales and billing functions, and accounting and tracking of supplies, inventory records, and expenses. So the big thing here is that we're looking at software or cloud computing service. That's the umbrella. Everything else is a category that falls underneath that. So it has to be a software or cloud computing service. So to the extent you're making payments for HRS systems, or if you've got payments for, if you're in certain lines of business, payments for delivery, tracking, sales, billing functions, all of those kinds of things would be underneath this. So if you're making those payments, then it's now a covered operational expense that you can use for the PPP. Covered property damage. So these are costs are related to property damage and vandalism or looting due to public disturbances that occurred during 2020, as long as they were not covered by insurance or other compensation. A couple questions that are already out there on this. We're assuming that if you've got a deductible, then you might be able to use the deductible here as an expense. We don't have any guidance to the contrary. That seems to make sense because at least a portion of that wasn't covered. There has not been any guidance on how we prove that there was damage due to vandalism or looting due to public disturbances. It isn't a situation where, for example, if SBA is declaring, certain areas economic disasters, or for dealing with natural disasters, where the government goes in and declares, yes, this qualifies. We don't have any guidance on that. I think it's highly unlikely that they go through and identify all the areas where this would occur. If we do have this kind of property damage or due to vandalism or looting, I would recommend that we document it. I'd recommend that we document any police reports, any insurance claims, and any documentation with respect to deductible. If we want to use this, again, absent some kind of additional guidance that provides more clarification. The biggest one here probably is this covered supplier costs. So this is kind of got two different categories. The first thing that all the categories have to be is that it has to be goods that are essential to the operations of the borrower at the time at which the expenditure is made, right? So it can't be the cost of goods where it's not necessary or it's not essential. It has to be something that we need in order to run our business. Obvious examples are food. If you're a restaurant and you need food delivery, that's essential. That's obviously a big one. The second bullet point here splits these into two different categories, right? And with respect to perishable goods and non-perishable goods. If the goods are non-perishable, then that delivery, that supplier cost must have been made pursuant to a contract order or purchase order in effect at any time before the covered period of the loan. So the question I'm getting, and we don't have any guidance on it yet, is, all right, so let's say that I've got a contract where I get, X amounts of widgets that are, non-perishable, and, basically I order them every single month. Every month I calculate how many I need and I order them and then I get them the following month. Does that count, even though each of those deliveries is made underneath a separate contract? We don't have the guidance on it, but I think it is because we can show that there is a history or a record of getting those. I think what they're trying to avoid here is all of a sudden you purchasing something that you don't normally purchase because now you've got the money to do it and it's an allowable expense. Something that, in their minds, that might indicate that it's not what you would consider to be necessary or essential to your business. So I think that's what they're trying to avoid. I don't think they're looking at this has to be basically a contract that was in existence that specified, you're going to get X amount each month moving forward. I think as long as you've got a history of making similar purchases from this entity for this item, I think that that's going to be enough. But again, this is the only guidance we have right now. So that's for non-perishable goods. Now, with respect to perishable goods, the contract only has to be in effect before or at any time during the covered period of the loan. So in that situation, it's clear here that the issue is anytime you're making a perishable goods, in their mind, it could be a new loan, it could be a new order during the covered period. They're going to allow that. That's a covered supplier cost. Again, the big thing here, this goes to restaurant industry, but it goes to a lot of other industries as well. If you got questions on whether a good is perishable or not, the SBA doesn't really have guidance on that, but I would discuss it and make sure you document why you believe it's a perishable good as opposed to a non-perishable good. So that's a big one, obviously, for a lot of employers, for a lot of borrowers. It's going to really up the amount of PPP money that they can use. We can move forward. So covered worker protection expenditures. This is in the interim final rules implementing the EAA, this is the largest chunk of definitions. So I've kind of slimmed it down here. If you have questions about what falls underneath this, I suggest you read the rules. I suggest you contact your legal counsel to make sure that you can fall underneath this. But it's defined as operating or capital expenditures that facilitate the adaptation of your business activities in order to comply with requirements and or guidance issued by federal, state, or local authorities. Think CDC, think OSHA, think Health and Human Services, and then think all of your state and local guidance, shutdown orders, issues about spacing, issues about in-person capacity, all of those things. Anything you do to comply with those kinds of orders, as long as those orders are kind of pertaining to or relate to maintenance of standards for sanitation, social distancing, or any other worker or customer safety requirement related to COVID-19. So this is money we spend in order to continue to operate business during COVID-19 in accordance with federal or state restrictions or rules about us doing that. So you're looking at your reopening plan if you had to make expenses in order to kind of operate under the New York reopening business plan that you submitted. Those are good examples. They do give some examples in the interim final rules. This is what they give: expanding indoor and outdoor footprint of the business. Think outdoor dining, indoor dining, coming up with outdoor dining places, air ventilation or filtration systems, physical barriers. I know it was a big one for our office, actually, is putting up in certain areas plexiglass barriers in between desks if the desks were too close. So I know that's a big one. Coming up with some kind of on-site or off-site health screening capabilities. If you are requiring employees to get temperature checked and there's costs associated with that before they enter, or customers get temperature checked before they enter, that could be something that falls underneath there. Purchase of personal protective equipment. There is some rules about this where they're not necessarily talking about all personal protective equipment. So if that's something you're looking at, you want to make sure that whatever you're doing, whatever personal protective equipment you're buying, is an eligible expense underneath the guidance from CDC and HHS, Health and Human Services. Additional or expansion of a drive-through. So if you didn't have a drive-through, but now you do, or you had to expand your drive-through, that would be an expenditure that fall underneath this as well. And then any other related expenditures, that's kind of their catch-all. So this could obviously cover quite a bit, especially in terms of the capital investments. If you had to make changes to the structure of your business, these things are now allowable uses of the PPP loan. So next thing here, changes to forgiveness. This is really important. Remember here that, and it's the last bullet statement, but I'll say it first. These changes in forgiveness apply to second draw PPP loans, but also to first draw PPP loans as long as the SBA has not remitted a loan forgiveness payment to the lender for the loan prior to December 27th. So if you have not yet applied for forgiveness, or if you've applied for forgiveness but SBA did not remit a forgiveness payment to your lender prior to 12/27, these rules apply to you. And we'll talk about what to do on the next slide. But that's just, these issues are not just second draw PPP, they're first draw PPP as well, unless you've already received forgiveness from the SBA. So the first big change is covered period. So previously, under the PPP and the PPP Flexibility Act, the PPPFA, initially the covered forgiveness period, which is the period where the money you spend on allowable forgivable uses are subject to forgiveness. It was initially an 8-week period that started on the day you received your loan from the bank. The PPPFA changed that to a 24-week period from the date you received your loans, with the exception that any borrower that received a loan prior to June 5th, 2020, which was when the PPPFA became effective, they could choose to use either 8 or 24-week periods. But you were locked in. It was either 8 or it was 24, and it started on this date and it ended on this date, and that was it. Now, there was some, if you remember back, you could kind of have some alternative forgiveness period where you started on, the first day of a new payroll cycle, a new pay period, to kind of bring that in and then go out. So there was a little bit of wiggle room, but still it was either 8 or 24 weeks. The EAA redefined that forgiveness period to add some more flexibility. Now the period still starts on the day you receive the loan proceeds from the bank, but you can select any end date that you want that falls sometimes between 8 and 24 weeks after the start of that covered period. So now you can have an 8-week period, an 11-week period, a 17-week period, or a 24-week period. This is beneficial because it allows us to kind of go in and decide, all right, if we wanted to use all this money, we had 8 weeks, then we would need to bring everyone back, and there's a risk in that. But if we don't bring everyone back, then we might not use enough for the payroll expenses during 8 weeks. But we can't go 24 weeks because we're not going to have enough to cover that. So then we're going to end up having an issue with reduction. Well, now if maybe the perfect number for you, the Goldilocks period is 12 weeks. Well, now you could do that under the EAA. Anything you want, and it's not something that you have to identify when you apply for the loan. It's something that you can set up when you're applying for forgiveness. So that's a big benefit. That being said, I would highly recommend that you do at least have a pretty good idea what period you want to use so that you can go into this eyes wide open and make sure that you're determining and using your money correctly for your projected covered forgiveness period. But again, it's not something that you have to do prior to receiving the loan. It's something that you notify on your forgiveness application what your covered period is. So very helpful. The next big thing here is that the 4 additional allowable expenses that we already discussed. So that's covered operational expenses, that covered property damage, covered supplier costs, and covered worker protection costs. They are now costs that are capable of forgiveness. So that's brand new. Not only are you allowed to spend money on that, but it's something you can now get forgiveness on as well. However, if you remember, we still have that requirement that at least 60% of the forgiveness and loan proceeds have to go to payroll costs. That remains. And initially it was higher, but the Flexibility Act changed it to 60%. That still applies. And like I said, applies to second draw loans and first draw PPP loans. We can go to the next slide and we'll talk about this. So if you had a first draw PPP loans, here's how these new laws impact you. If you've already submitted and received forgiveness for loan forgiveness from the SBA, as of right now, then these steps don't apply to you. Your forgiveness was calculated on the pre-EAA rules, and as of right now, there's nothing we can do to change that if it was prior to December 27th. If you're one of the unlucky few that you received your forgiveness, SBA remitted that loan forgiveness to the lender after December 27th, then underneath the law, the plain language of the law, these new rules apply to you, but we have no guidance yet on what to do. As in, if you didn't receive full forgiveness because you were operating under the old rules, but that forgiveness decision was made on December 30th, and that's when the bank received the money, technically these new rules apply to you, and you should have a chance to go back in and expand that, but we don't have any procedure for that yet. There's no guidance on that yet. All right, so it's something to keep in mind. And if you're in that situation, keep your ears open and talk to your bank about their idea of the process. If your forgiveness application has been submitted but not yet completed, the forgiveness hasn't been remitted by SBA to your lender, but you are going to be receiving 100% of your loan forgiven, then you're not in a situation where you need to make any changes. If the bank approved 100% forgiveness, you didn't need any of these new additional expenses or any of the new additional rules with respect to covered period flexibility. Doesn't matter to you. If you submitted an application for forgiveness with less than 100%, you should review these new rules and see if utilizing them gets you to 100% forgiveness. If that's the case, you should talk to your bank immediately. And again, we don't have a process for this yet, as in, hey, I'm withdrawing my application, especially if the bank's already forwarded it along to SBA. There's no rules or guidance on what the process is going to be. But if we're in that situation, look at these new rules to see if you can get more forgiveness with the added flexibility and the added allowable expenses. One big thing, as of Monday, so this is if you haven't even submitted a forgiveness application yet, and you plan on using these new allowable expenses that the interim final rules indicate are now subject to forgiveness. As of Monday, the forgiveness application had not been updated to allow those additional expenses. And I have worked with banks last week that were pushing back on this, saying, well, we don't think that these new allowable uses are apply to first draw loans. The interim final rules make it clear that they do, but it's because the application hasn't been updated to include them yet. A lot of banks aren't aware of that yet. So if you haven't yet submitted a forgiveness application and you're going to be needing to use those new rules in order to give 100% forgiveness, it's probably best to hold off a little bit and wait and see if we get anything from the SBA. In terms of timing for forgiveness, generally speaking, as long as you submit an application for forgiveness within 10 months of the end of your covered period, then you're going to be okay. The interest payments and everything else is delayed as long as you get that application in within 10 months. So you have some time. And again, that would only apply if you are, under the old rules, you couldn't give it 100% forgiveness, but under the new rules, you think you're eligible for it or you can. If you're interested in looking at these rules, these general rules that apply to both the first draw and second draw PPP loans with respect to new expenses, that's the link. They're long. I think it's 54 pages in that typical, federal triple or quadruple column, but there is quite a bit of information there. And as far as interim final rules go, they're fairly easy to read, and they actually make sense. They kind of set them up almost as in a Q&A, a very long and detailed Q&A. So if you're, I guess if you're interested, or if you're really bored and you need something to help you fall asleep at night, you can always take a look at those. So going on to second draw PPP loans, which I think what most people are interested in, the EAA allowed these second draw loans for certain eligible people. The eligibility criteria are narrower in a way. The one exception to that statement of narrower is that all those other new entities, the 501c6s, the destination marketing, the housing cooperatives, they're still eligible for second draw loans, but first they have to get a first draw loan. But generally speaking, not everyone that was eligible for a first draw loan will be eligible for a second. So the first thing that you have to do is you had to do something that was eligible for and received a first draw PPP loan. Obviously, you're saying, well, hey, if you received a first draw loan, then why is the eligibility there? Why is that statement there? There are probably quite a few entities that received first draw loans that weren't technically eligible due to things like not properly including affiliates when calculating size, or not correctly applying the pre-existing SBA rules with respect to ineligible entities, and their bank not realizing that those applied. So they applied for and received a loan. You might have received one, but you might not have been eligible. So that's something to keep in mind there. The other is that the borrower, along with any affiliates, has to have 300 or fewer employees. So again, that's different. Under the initial PPP, it was 500. Again, at this point on affiliates, I can't stress this enough. You need to count employees of all your affiliates. And the third category is you have to use or will have used the full amount of the first draw PPP loan on eligible expenses on or before the date the second draw loan would be dispersed. And the second draw loan has to be dispersed within 10 days after it's approved by the SBA. That's the longest you can delay. So they don't want people getting a second bite of the apple if they still have fruit on the first apple they haven't eaten. They want to make sure this is people that have used all that money. For most people, this won't be an issue. If you applied for and received a loan early in the year, then this won't be an issue. One big thing here is that it doesn't, you don't have to have received forgiveness for the first draw loan. You don't even have to put in an application for forgiveness. Even if you have, let's say, and maybe only 50% of your first loan is forgiven because you had, layoffs and you couldn't get your full-time employee count up. That's irrelevant. It doesn't matter where you are on forgiveness or how much of that first draw will be forgiven. This is about using it on eligible expenses. And the big one is you have to have experienced a qualifying revenue reduction in 2020 relative to 2019. In my initial draft on this, I had reduction in 2020 relative to 2021. So you can tell that it's been a busy week. But yeah, you're comparing 2020 to 2019, and we'll go into detail on a couple of these points in the following slides. So the 300 employee size limit, right? So you along with any affiliates must have 300 or fewer employees, right? So first point, affiliates. The SBA's prior rules on affiliation still apply. So make sure you're looking at that. Anytime we have entities related by ownership, that's going to be a big red flag. Parents, subsidiaries, brother, sister corporations, all of those things are important. You need to look into them to make sure that you qualify for that size reduction. When we talk about 300 employees, how do we calculate that? And this gets a little bit tricky because anybody that was involved in the forgiveness application process went through a process of determining full-time equivalents in order to show that they are eligible for forgiveness without a reduction due to a loss of FTEs. Those rules don't apply here, right? So this is the initial rules for size, and what they're looking at is, generally speaking, the average total monthly employees, which includes full-time, part-time, per diem. So here, someone who works 40 hours a week and during 1 month, and somebody that works a total of 10 hours during 1 month, they both count as one each. So we're not looking at full-time equivalents. We're just looking at total bodies, total head counts. So you take that average for the 12 months prior to the date of the application. That's the pre-existing SBA rule. Now, under the initial PPP rules, they gave employers and borrowers the options. You could either use the 12 months immediately preceding the date you submitted your application, or you could just choose a 2019 calendar year. That's actually, I believe, on the initial PPP loan application. There isn't anything similar with respect to the second draw application. So again, I would talk to your banks about this. Banks, as they have been, are going to be the initial arbiters of what's allowed with respect to second draw loans, just like they were with respect to the first draw and just like they were with respect to forgiveness. So work with your bank on doing this in terms of qualifying for size. One exception to this 300 limit, if you are an employer in the accommodation or food services industry and you've got an NAICS code starting with 72, and if you are one of those entities, you'll know it, then you can have 300 employees at each of your business's physical locations. So that's the exception. You've got an entity, you've got that 72 code, and you own 10 restaurants, and you've got 50 employees at each. Well, if you were all affiliated grouped together, then you wouldn't be eligible. But they've specifically carved this out, saying that we're looking at those entities on a location by location basis, as opposed to adding them all together. That's the only exception. So we can go on to the next slide, the revenue reduction requirement. This is a big one. It's gotten a lot of press. The one thing I'll say at the outset is talk to your accountants, talk with your accountants, talk with your accountants, right? So this is an interesting process. And if you're not sure, you really want to talk to your accountants and talk to your banks, and I'll get to why that's important later. So in order to be eligible for a second draw loan, you have to experience a revenue reduction of 25% or greater in 2020 relative to 2019. So in order to determine this, you have to compare your quarterly gross receipts for one quarter in 2020 with the gross receipts for the corresponding quarter in 2019. So you're comparing 2Q 2020 to 2Q 2019, or 3Q or 4Q as you go. The other alternative, if you don't want to do that, but you're sure that you've got it, is you can compare the total annual gross receipts in 2020 with the annual gross receipts in 2019 to show a 25% reduction. If you were not in business in 2019, you also can show a reduction between Q1 2020 and the remaining quarters of 2020. Again, that's if you don't have the 2019 records because you weren't in business. And we're going to continue to talk about gross receipts on the next slide. So what is gross receipts? This is and this is actually on the application as well as in the IFRs, and it's a little more in there, but I didn't want to copy and paste the entire thing. So it includes all revenue in whatever form received or accrued, depending on your accounting method. If you're accrual basis or cash basis, you're looking at that, from whatever source. That includes sale of products or services, interest, dividends, rents, royalties, fees, or commissions, reduced by returns and allowances. Generally, receipts are considered total income, or if you're a sole proprietor or independent contractor, your gross income, plus cost of goods sold. Some things that are not included are net capital gains or losses, as those terms are defined in the IRC. So this is a finance and a math problem, which generally puts it out of the purview of an attorney, thank goodness. But again, work with your accountants on this to figure this out. One important thing is that the gross receipts does not include any amount of forgiveness that you received on the first draw loan. So if you received, a $200,000 loan and the entire thing was forgiven in 2020, you don't have to add that $200,000 forgiveness into your gross receipts to see if you suffered a reduction, which is a good win, something that we were pushing for. If you have affiliates, it matters with gross receipts. So the IFR provides that the gross receipts of a borrower with affiliates is calculated by adding the gross receipts of that particular borrower together with the gross receipts for all their affiliates. So what this means in real life is that if you've got 4 affiliated entities, one of them had a tough year and had that 25% reduction in gross receipts, but the other ones didn't, that when you do the math, there's a good chance that you won't be eligible for this loan, even though you yourself suffered that loss, because when you combine the gross receipts for all your affiliates, you didn't meet that 25% reduction threshold. In the same way, there are a bunch of specific rules that apply to any kind of borrower that either gained or lost affiliates during the 2020 year, either because they were bought or because even a partial ownership share, either the entity itself or a portion of it was bought or sold, or the borrower itself bought or sold another affiliated entity. There are specific rules that apply to that. So if you're in a situation where you had any kind of change in your corporate structure in 2020 with respect to ownership, this is something to keep in mind. Work with your counsel. There are a bunch of specific rules for that. Your accountant can probably help out as well. So how do we calculate the loan amount for second draw loans? So generally, the maximum loan amount is 2.5 times your average total monthly payroll costs that's incurred either during 2019 or 2020. So borrowers can select, I'm going to use a 2019 as my base period or 2020 as my base period, up to a maximum of $2 million. One thing, and I'll probably repeat myself later, we don't know what the impact of using 2019 versus 2020 is in terms of forgiveness. So the initial thought is, I'm going to use 2019 because my payroll costs were higher in 2019, so of course I'm going to use 2019. Possibly, and we don't know this yet, we don't have any rules on the any of the safe harbor provisions with respect to second draw loans, but I do mention that later, but I want to touch on it here. If we use 2019 because it's higher, because we had more employees, because we had more payroll, it's possible that that's the standard we're going to be measured against when determining whether we get full forgiveness. Again, we don't know that, but keep that in mind. It's not necessarily a free lunch to go with a higher number. I know most people are going with a higher number because they want the money, but it's just something to keep in mind. We don't know that yet, so there might be some risk involved. For borrowers with the accommodation food service sector, again, these are those NAICS code 72s. they have a higher maximum loan amount. It's 3.5 times their average total monthly payroll costs incurred either during 2019 or 2020 at their election. And then this new one is very, I think it's very good. It's for seasonal employers, and it's nice that there's a specific element here. It really kind of helps them out. But they look at this, it is either 2.5 times, or again, if you're seasonal and you fall underneath that food and beverage or food and service sector, 3.5 times. But the average total monthly payroll costs incurred by the borrower for any 12-week period, your 12-week period of your choice between 2/15/19 and 2/15/20, or $2 million. So what this does, previously, if you remember, for seasonal employers, they were kind of stuck because, you know, they were looking at when you're averaging out your 12-month payroll for 2019, well, if you're only in business for 6 of those months, or only really heavily in business for 6 of those months, then boy, your average payroll is going to go down, but that could hurt you if you actually happen to be during a busy time. So this is a new rule for seasonal, which I think is very helpful. There are some specific rules with respect to whether or not you qualify as a seasonal. So if you're a seasonal employer and you're interested in this, I would go through those rules with your counsel and make sure that you're eligible. They're fairly straightforward, but we just want to make sure that we can certify in good faith that that situation applies to us. So, and this is where I'll begin to repeat myself, forgiveness rules. First caveat, the interim final rules under the EAA specifically said that they plan on issuing a set of interim final rules for forgiveness. As of right now, absent any guidance to the contrary, and absent those elements that are new to the forgiveness process that we already discussed, the new allowable expenses, the changes to cover period, that flexibility, all the old forgiveness rules, they apply to second draw PPP loans. And again, we expect guidance. We don't know what they're going to do. And this goes back to that decision of are we using 2019 or 2020. So remember those old rules. Our amount of forgiveness can be reduced if we have a reduction in employee wages beyond a certain point, right? 25% in pay rate or salary. That reduction can be reduced if during the covered period our full-time is lower when compared to a baseline period. If you remember previously, the baseline period was prior to the first loan, February 15th, 2020. What we don't know right now, the important thing is what that baseline period is for the PPP second draw loans. Is it going to be when we submit the application for the second draw loans? Is it going to be when the law was passed? Is it going to be some previous date? We don't know. Is it going to be dependent on what period we use for payroll when we're determining our payroll costs for the loan amount? That we don't know yet. So just remember that as of right now, all those rules still apply, and there's a little bit of uncertainty. I actually received an email from a client this morning saying, I have concerns that I might not be able to get forgiveness on this loan because I don't know if I'm going to be able to go back to my 2019 employee status. Is that a valid concern? The answer is yes. That's a valid concern. We don't know what you're going to be compared to. We don't have guidance on that yet. It's likely that we're going to have similar safe harbors, right? So if you remember, there was safe harbors that prevented a reduction in forgiveness if you, for example, restored any salary or pay rate reductions by a certain period in time, or if you rehired employees by a certain period of time, got your FTE count back up, or if you attempted to hire people but they wouldn't come back, or if people quit, it wasn't somebody you laying them off, somebody quit. All those safe harbors, as far as are going to apply. Again, we just don't know the dates. We don't know when we're going to look at the baseline period, what snapshot that's going to be, and we don't know when we have to get our numbers back up to that in order to avoid a reduction in forgiveness. Hopefully that's something we'll have soon, but as of right now, we don't have it. The process. So the application has been published. I'm sure you've all seen it. The big thing here I'll say is, again, work with your accountant on the gross receipts issue. Work with your attorney if your accountant needs advice on gross receipts. Gross receipts isn't defined under the EAA. SBA is applying a definition that they previously used for gross receipts. What gross receipts is can differ depending on what type of organization you are, whether you're a partnership or you're a sole proprietor. independent contractor, self-employed, it could be a little different, but work with your accountant to make sure that you can qualify for that and that you can actually get the documentation you need. So the big thing here is for any loan in excess of $150,000, you're going to need to submit documentation to your bank in order to be qualified for a second draw, in order to get it, showing that you have the qualifying reduction in revenue. If you're under $150,000, you don't need that at the time of application, but the rules say you are going to need it when you submit an application for forgiveness. And oh, by the way, if you don't submit an application for forgiveness, then SBA will reach out at some point and ask you for that documentation. So in terms of what they're looking for here, tax documents, this is actually guidance that was updated this morning. Again, perfect timing. And so it's not in my presentation, but I have it here. I'll just read it. Here's the type of things that you can provide: quarterly financial statements for the entity, quarterly or monthly bank statements. If you're looking at 2020 versus 2019 as a whole, as opposed to looking quarter to quarter, you could do annual IRS income tax statements. If you're a sole proprietor, kind of similar things, you can do your tax documents to the IRS. That's great. Tax documents are probably the best because you've already filed them. You already, to the extent you have filed them or you will be filing them, you know they're going to be accurate. If you haven't already filed for 2020, or you're not going to file for 2020 prior to issuing that loan, then you might not be able to use those and might have to use the other ones. So again, if you're over 150, you're going to need to provide that documentation when you apply. So start working with your accountant to get it all together. If you're under 150, you still want to work with your accountant to get it together to make sure you can make those certifications in good faith. The other thing to keep in mind is that you want to make sure, just like on the first set, that you are making all of the certifications of eligibility on that loan application in good faith. Obviously the first one was the big issue there was, the certification that the loan was necessary due to economic uncertainty. That got a lot of traction, a lot was spoken about it, a lot was issued on it in terms of guidance. That's still there, obviously, but there's other things as well. The affiliation, the size, that's important, and the reduction in revenue is important. Another thing to keep in mind is if you made a mistake on your first application, let's say you were early, right away you submitted your application for your first draw loan back in the spring, and you didn't understand the affiliation issue, and so you made a mistake and you didn't identify any affiliates as required. If you identify them now, which is the correct thing to do, expect to get some pushback or investigation from SBA, because now they've got two applications for a related entity, for the same entity, one indicating that it has affiliates and the other one not indicating that it has affiliates. So you want to be correct. Just because you made a mistake the first time through, we don't recommend making the same mistake again knowingly. Work with your bank to kind of address that and be prepared to address that if you realize that you made a good faith error. I think we can so that's the end. Again, thank you for this. I know it's kind of thick. I know that the frustrating part is we still have a lot of questions that we don't have answers to yet. But we'll continue to review guidance as it comes out and provide any additional information that we can as we go forward. But I think we're going to open it up now to any questions that were asked during the presentation.
We are, Josh. Thanks. Thanks so much for this really clear presentation on a complicated topic that really does need a lot of explanation. So thank you. I'm Nancy Proyect. I'm with the Orange County Citizens Foundation, and I'll be facilitating the Q&A today. And I'm sure, Josh, you mentioned that not everything is out yet or clear yet. And I'm sure we're going to ask you to come back at a later date when more guidance is out to update us, to provide us with more information. So, so be ready for that. But let's get started with today's questions. First, I just want to be clear so that you did provide us a link to the application. And I remember for the first PPP, your banks also had applications. So will this be the one application that everybody can fill out, or will banks be requesting further information? Do you know?
So based on my experience so far, my conversations with banks so far, it looks like it's going to be similar to the last experience where many banks will set up online portals, which collects the same type of information that's requested on the application, but not necessarily in that format. I think prior to getting to that stage, if your bank doesn't yet have an online portal for that, you can at least go through the process of completing the application internally and gathering the correct information so that it'll be easier to fill out whatever online, or portal linked application your bank uses. But the SBA says specifically they can use this application or one, similar, basically same for all federal and state notice forms. You can use this one or something that has the same information and same components. So my guess is many banks will not just accept a PDF of this application, but talk to your bank, see what they're going to do.
Okay, great, thank you. Our first question is from a nonprofit that has a board member that lives in China. Does that exempt, does it make that organization ineligible to apply for the second round?
It's funny. I read something on this, but it's not triggering my mind. There might be a concern there with respect to foreign participation on a board. I've got to go through and look at that again. It wasn't something that I was actually looking at specifically. I just know that I read something on that. So that's one I'm going to have to get back to you on. It applies to kind of foreign ownership, foreign entities and affiliates that in China specifically is addressed. So I've got to double check that with respect to the application to a nonprofit. And I'll get back to you on that one offline, Nancy.
Great, thanks very much, Josh. Okay, and then the next question is Quickbook covered? So I'm imagining that has to do with the new types of eligible expenses. If you use QuickBooks to do your payroll or just your accounting, would that be covered?
I would think so. Again, there hasn't been any guidance saying yes, absolutely, but depending on how you use it, I would look at QuickBooks falling under that covered operational expenses because it's a business software that's facilitating business operations in terms of accounting and tracking. So I would think that would fall underneath that. I can't say yes, absolutely, but if QuickBooks doesn't, then I wonder what would. It seems to me like that would be a basic
Right.
one as long as we're using it for accounting purposes and tracking financials. That would make sense to me.
Okay, and then similarly, if you have a bookkeeper or an accountant who's an independent contractor, can you then pay that type of expense under the operations?
Probably not, because with one caveat, and again, all this is open to more guidance. All we have on business operational expenses is that paragraph that's in this presentation. That wasn't me kind of condensing like I was, but the one exception I might say is if the independent contractor, either the entity we're using, bills us separately, like a line item for access to the software, then potentially, arguably, we could. But if it's just kind of going to that business or that independent contractor, kind of a general lump sum payment, and then they pay for that, then maybe not. Then probably not. Again, with a big caveat so theoretically, if we're getting invoiced separately for a software or cloud computing service that falls underneath that, then maybe. But if not, then most likely not. Again, pending additional guidance.
Okay. If you have a paper trail but no formal purchase order for perishable goods, do you think that would be acceptable?
So I'm guessing that I'm wondering what the paper trail is in terms of this, but there's been no indication there's going to have to be any kind of formal purchase order. I'm assuming if we have a paper trail of in some way us ordering or requesting goods and then us paying for those goods, I'm assuming that'd be enough. I would take pains moving forward to document that a little better, especially if you're looking at a second draw, just so that we don't get stuck, so we're not going to be, potentially not able to use it. So I would formalize that process, identifying the goods, identifying the data order, data delivery, and the costs. Moving forward with respect to the second draw cover forgiveness period. With respect to first draw cover forgiveness period, again, there's no indication that that's going to be necessary, but I'd want to make sure that we have enough documentation that we can show this occurred and what those payments were for, and why they were, either perishable or non-perishable, and why they were necessary for any past covered period. But again, pending any kind of guidance to the contrary, nothing official, but I would want to make sure we got that paper trail and do our best to, at this point, since we're kind of close to that period, if it's already passed, shore it up, add detail, so that in 2 years, if we get audited by the SBA, we can defend it. And then moving forward for new loans with new covered periods, I'd formalize that process just to avoid that issue altogether.
Okay, great, thank you. This next question goes back to the seasonal businesses that you mentioned earlier. If you didn't use the full amount of your last PPP and you will not use it within the guidelines because you weren't allowed to operate because you were a seasonal business and closed, can we return the balance of the first PPP and apply for the second?
That isn't something I've looked at. I think my gut, and I will look into it more, I'm not sure if I'll find more answers, my gut would be no. Because in their mind, they're saying, well, no, you still have a balance from your first PPP loan. So, we're not going to allow you to get a second one until that's done. I know that in I guess an application or in process, that's kind of unfair, especially if you're in a situation where you can't use it, but you're looking forward to the future where you might be able to use it, so you want to get the second draw loan. I think they would say, no, you still have money from your first. We're not going to allow that. I'll look at that. I don't believe there's any guidance on that, but I'll look through the rules again. But my gut would be that no, that's going to be a situation where they're not going to allow that. And again, one thing to keep in mind, and it probably doesn't apply here, but in general, it doesn't matter if the PPP loan was used within the quote unquote covered period. They're not interested in that, and they're not interested in meeting enough payroll. They're just looking at whether at any time prior to that second draw loan, you've used that amount of money on any of the allowable expenses. So you might still have some time prior to March 31st, assuming the funding lasts until March 31st. You might have some time to use the rest of the first draw loan and then any of those new operational expenses, or go back and see whether you have any of those other new allowable expenses that would allow you to meet that threshold. Again, the caveat here being that, if doing that, you might not get forgiveness if your FTE reduction is so high due to the fact that you weren't able to operate. The other point I'll make here that I didn't actually address in my presentation, but you're not eligible for a second draw loan if you're not in business. So if you're no longer in business and you don't intend to reopen, then you're not eligible for a second draw loan. If you're temporarily suspended, but you plan on reopening, then you are. But if you're done and you're not going to operate, you don't plan on reopening, then you're not eligible for a second draw. Obviously, there's a lot of companies that are in limbo there, because whether or not they plan on reopening depends on whether or not they can stay afloat until a time when they're allowed to reopen financially. So in those situations, I think make your best good faith and document your estimation that you do plan on reopening, so you don't get Monday morning quarterbacked about your decision unfairly. Say you never opened. We think you never planned to reopen. Document that so that you can at least have some evidence that you did plan on reopening. It just didn't work out that way, if that happens to be the case.
So then maybe, Josh, the best question I can ask now is from a listener who says we are an S Corp. And this question is in regard to reduction of wages. So they've not reduced their employee wage rate, but they did have to stop payroll due to a lack of funds starting in December 2020. So their PPP-1 ran out this summer and their clients are paying on receivables, but they have been delayed, which caused the payroll stoppage for December. Will the SBA view their average payroll as a wage reduction, which is January through November? Will they review it as wage?
Sorry. That will, assuming you use 2020 to calculate your average monthly payroll costs for calculating your loan amount, that will be included. So that those zeros in December will go into your average monthly payroll costs. if you use 2020. But in terms of, the reduction in forgiveness based on a reduction in salary, it's probably not, because really what that is a reduction in FTE, assuming that people weren't working that month. So you don't get hit twice. You don't get dinged twice for reducing someone's pay. If you cut somebody's hours, for example, from 30 to 15, that's a reduction in FTE. It's not a reduction in pay rate or salary, unless you actually reduce their hourly rate or pay salary, is kind of the approach we're taking on that. So it would be unfair if you reduce somebody from 30 to 15. So now you're having an FTE reduction, and then on top of that, because they work fewer hours, they get paid less. You're also getting hit with a salary reduction. That's not what they're going after. So we don't think it apply in that scenario, but it would apply to reduce your average monthly payroll for loan amount calculation.
Okay, great, thank you. Just to clarify, is the calculation for qualified revenue reduction based on a calendar year or a fiscal year, or does it matter as long as it's your quarter?
Yeah, right now they're looking at the rules say Q1 through Q4 2019 compared to Q1 through Q4 2020, regardless of whether you're on a calendar year or a fiscal year. Okay. That's their current standard. I haven't seen anything to change that. There's a chance they might change that with guidance, but as of right now, they're looking at the calendar year 2019 and calendar year 2020, the quarters within those.
Okay. And then again, for clarification, I believe you addressed this already, but your forgiveness application does not have to be complete before you apply again. Is that correct?
Correct. Yep. There's nothing. All you have to do is certify that you have used or will use the full amount on allowable uses, allowable categories prior to the time you'll get the second draw loan. Doesn't matter whether you've submitted a forgiveness application or whether you're going to be receiving forgiveness. It's just that you've used it on allowable uses. It's gone. That's the only important thing.
Okay, great. And then you mentioned providing tax documents for your revenue reduction. Are there other types of documents you can use? I think you mentioned some in the presentation. Can I use my P&L?
Yeah, so this is one thing where two things. One, work with your accountant. Two, it's going to depend largely on what your bank requires, absent more guidance from SBA. But the examples that are given are quarterly financial statements. If they're not audited, you've got to sign and date the first page and initial all the other pages attesting to their accuracy. If your financial statements include things that aren't included in gross receipts, you've got to go through and annotate which elements are included in gross receipts and which aren't. Work with your accountant on that. If you don't have quarterly financial statements, then you can even use quarterly or monthly bank statements showing deposits for a relevant quarter. Again, with the same caveat, if it's not clear which deposits go into the gross receipts calculation, you've got to identify which ones, so someone else can go through and do the simple math and check and make sure you had that reduction. So those are the alternatives to the tax documents. If you're going to be using tax documents, then there is an entire list. And Nancy, I'll send you this new Q&A that was published this morning that includes specific entities. So just for example, tax documents. If you're a nonprofit organization, you're going to use IRS Form 990, and it lists the lines that have to be summed together when determining gross profits. So it has more detail depending on the type of organization you are. I'll send that to you so you can share with a group. Again, Treasury and SBA just put it out this morning.
Great, thank you, Josh. And what we'll do is we'll post it along with your presentation on the IDA's website. So appreciate that. Okay, next question. Do you have any guidance on the FTE requirement for forgiveness? I guess the SBA had said if your business or programs are reduced through no fault of your own, the FTE requirement might be waived. Do you have any information on that?
Yeah, so I believe that this is relating to one of the safe harbors in the PPP Flexibility Act that applied, back in June, started as of June, applied to first draw loans, and potentially have some additional guidance will apply to second draw loans too. and that's a situation where you could not return to February 15th, 2020 levels due to a reduction in business operations that were caused by compliance with CDC, OSHA, HHS guidelines with respect to the prevention of COVID, or state and local rules, guidelines, executive orders that were based in part, at least, on those federal orders. Easy example here is the common one is a restaurant that can no longer handle the in-person seating, so they have reduced in-person seating, reduced staff, wait staff. Yes, they still can do takeout, but they can't return to their full capacity, so their FTE reductions are reduced. That's not their fault. Their loan will not be reduced. That is a safe harbor that pre-existed it. It's actually, it's an incredibly important safe harbor. So I'm frustrated with this particular safe harbor. It's been out since June. It's incredibly important because it could potentially apply to a lot of entities and result in 100% forgiveness with no reduction based on an FTE reduction. So it's significant, it's important, and our total guidance on it to date is about 3 paragraphs, right? 2 paragraphs one paragraph in a set of interim final rules, and a paragraph or 2 on the application instructions or the application for forgiveness that had predated the second draw rule. So it's extremely limited. So it's very frustrating. I've worked with a lot of clients on that. If you think you're eligible for that, I would work with your attorneys to receive, have them kind of draft a memorandum outlining why you believe you're eligible and pointing to the guidelines or the rules you had to comply with that resulted in this and the financial statement. So at least you have that. So if you're going to put that on an application, you have an argument that you made that certification that you're eligible for that safe harbor in good faith. That being said, in all but the very simplest and most straightforward examples, like the restaurant one I gave, we still don't know how SBA is going to apply that and the details of that and whether we're going to get pushed back after the fact. So I feel your pain on that. It's frustrating we don't know more. I'd work with legal counsel familiar with that exemption to kind of provide you with a memo that includes all of your reasoning, why you think you're eligible for it. So at the very least, you can have a good faith basis for making that certification.
So for going back to that camp that did not open, they should work to document if they have a safe harbor for their full-time employees because they didn't have counselors?
Absolutely. If they were not allowed to participate in the camp due to, for example, a state or a local shutdown order that didn't allow them to do it, or put such restrictions on them that they weren't allowed to, it wasn't feasible to do it, that's something that I would look at and certainly approach that potential safe harbor. Again, so I've probably worked with a dozen clients, probably more than that now if I think about it, on that particular issue. And I think I've had, 2 where it was like, yep, absolutely. You're lucky. You're the example that was actually cited by, the SBA and Treasury in meeting this requirement. For everyone else, it's up in the air. But based on the language of the statute, I think people are going to apply for it. But I just don't know how, SBA is going to view that in all the unique situations. But again, it's something I would certainly consider. It's a huge safe harbor. And if you got a good faith basis for making that claim, then I think it's something that might be worth it. You just have to weigh the potential cost benefit analysis of making that.
Okay, thank you. Going back to the operational expenses that you can use the PPP for, how about receipts and payroll invoices from a payroll company?
So I'm guessing here we're talking about the fees that we pay an entity to run our payroll. Would that be?
So, yeah.
Nancy, you think that's what we're going
Yes.
for here?
Yeah.
So based on the limited definition, SBA could argue that you're not paying for a business software or a cloud computing service. Maybe, at least not a business software, maybe it falls underneath the cloud computing service. They haven't defined that. So it's something I would think about including and look at. But absent additional guidance on that, six one, half dozen of the other. I just don't know how they're going to interpret that. I would think it works because it's payroll expenses, right? That I just don't know whether it would qualify as a business software or cloud computing service.
So you're really looking at it as the software, as the computer program, not the assistance that you receive from a payroll company or an accountant who's assisting.
That's absolutely right, and it's not just me. It's the way they wrote it. So the first category has to fall underneath is any business software or cloud computing service. Now I admit, I'm only 39, but I have no idea what a cloud computing service is, other than maybe some Amazon commercials I've seen on TV before. But what that is, I'm not sure in terms of how big that umbrella is. But the first thing you have to be is either a business software or a cloud computing service. So and then it's the things that it facilitates and does underneath it. Potentially a payroll could be a cloud computing service. It's just it was weird the way they set it up, and the first thought that came to my mind was, oh, I wonder who the lobbyists are that push for that. What company are they representing? Is it IBM? Is it Amazon? Because it's one of those situations where it's obvious. It's weird that that's the first category that it has to meet is business software or cloud computing service. But that's still kind of up in the air. I think you could argue that that's the case, but it might be as simple as talking to your payroll company and saying, listen, is this cloud-based? Are we paying for a cloud computing service? And if we are, then great. Or are we paying for a business software? I think it's an easier scenario where you are, you've got payroll and you're utilizing their software yourself for something else, like employee tracking or benefits or some other HRS thing. I think that's easier, much easier case than basically, we're sending an Excel spreadsheet to our payroll company and they're producing payroll. I think that's a harder sell.
Okay. I want to make sure too that that independent contractors are not eligible under this new PPP, right? This is still for your the payroll that you're paying employees, full employees. Is that correct?
Yeah. So under the PPP, it's still employees, independent contractors, sole proprietors. They can they have to apply underneath their own as of their own business, as of their own entity. That was something that was confusing in the beginning before they clarified guidance. A lot of because one of the things they included in payroll costs was payments made to independent contractors. That was a mistake on their part. They meant basically money received by an independent contractor when the independent contractor is applying for a loan in their own right. So we're only looking at employees, not payments to independent contractors under the PPP and the second draw PPP. But if you're an independent contractor or a sole proprietor, then you can be eligible as well for second draw loans, as long as you meet other criteria.
Okay. And then our final question is a bit of a more general question, but it's a question about what really is a business affiliate. Is it the same owner but different tax IDs? Are there individual entity affiliates?
Yep. So the great question, and there's a ton. I think the SBA's has a 25-page PDF on its affiliation rules. So I'll give the basic answer, but it's the devil's in the details with respect to the affiliation rules of business concerns. But what we're looking for generally is any kind of joint ownership, any kind of related ownership. So the easy example is a parent company that owns 100% of another company. They're affiliates. That's your basic parent sub organization. Another easy example is, company A is owned by individual 1 and individual 2, and then company B is also owned by, at least in part, company individual 1 or individual 2. So even if the companies themselves are not related, other than the fact that they have some form of common ownership, that can trigger an affiliation. And it doesn't necessarily, in all situations, have to be, controlling ownership interests. Another way to link this, which is similar, is the the IRS's aggregation rules. So, it could be that a group of 4 people control a controlling interest in one company, and that same group of 4 people, or some makeup of that 4 people, whether one person or 3 of them or all 4 of them, also have a controlling interest in another company. That could be enough to trigger affiliation rules. So whenever you have any kind of owner of one company that has ownership in any other company, that's something to look into. The other thing too is sometimes the ownership interests of children are attributed to parents, and ownership interests of parents are attributed to children. Same thing for spouses and other relatives. Sometimes there's, even if you don't own it, if you're related to someone who does, you can have that person's ownership attributed to you as well. So lots of rules. Like I said, there's like a 25-page rules there. If you have any questions about that, work through that with your attorney to make sure that you feel confident you can make that certification.
Okay, great. Thank you, Josh. You've answered all of the questions that people submitted today and provided such great guidance. We really appreciate it. I want to remind everybody that you can rewatch this presentation, or you can re-listen to the presentation and check out the PowerPoint presentation that Josh provided by visiting the Orange County IDA's website at ocnyida.com. Sorry, I think that's right. It's ocnyida.com. And we'll also post the question and answers that Josh referred to, the new question and answer document that Josh referred to. We'll post that as well. So that should be on the website sometime today. And as a reminder, all of our previous presentations and webinars are up on that same page. So we encourage everybody to take a look at that. And we will also present future webinars on this as we get more information. So thanks everybody. Again, thank you, Josh. Thanks, Dean Brady, for taking care of all of our technical needs. And we look forward to talking with everybody again. Take care.